Good morning, America. I'm Spencer Christian, in for Joan London this morning.
And I'm Charles Gibson. It's Thursday, December 17th, and there is sort of a missing something or other here between us. Joan's off with a sore throat. Hope she feels better, and hopefully she'll be back tomorrow. You know, for years, the three letters IBM seemed to symbolize the stability of corporate America. Now, as stockbrokers were joking yesterday, it stands for I've been mugged. Its stock plummeted in recent days to an 11-year low after the corporation announced its job-cutting plans for 1993. What happened to IBM, and what does this downsizing mean for our slowly recovering economy? Whether you invest in the stock market or whether you don't, IBM's plummeting stock price this week really does have repercussions far beyond its own shareholders. The cost of an IBM share fell to an 11-year low yesterday, following news that Big Blue, as it's called, will start laying off 25,000 workers next year, the first formal layoffs in IBM's history. What went wrong? What do IBM's problems say about the rest of the American economy? Well, joining us from station WCVB in Boston is Roger Brinner. He's the chief economist at the economic forecasting company of DRI McGraw-Hill. Also with us in Boston is business writer Jack Falvey, and I thank both of you for joining us. Roger, let me start with you. What went wrong?
Well, IBM had a beautiful mainframe computer business where they owned the hardware and they controlled the software, and everyone went to their security. That was the place to buy that kind of hardware and software, and it was a very protected market for them. And then personal computers took over, and they didn't control the software. A man named Bill Gates in Microsoft had an operating system that absolutely anybody could combine with their computer, and that was the end of IBM's empire. They had built a great big castle with a moat around it, around mainframe computers, and everybody moved to a different valley.
We've seen a lot of big companies now laying off workers. I mean, the GMs, the GEs, the Sears Roebuck, etc. Is big no longer better?
I think that might be the case, because when you get very big, you may not be looking for the small opportunities that are going to change your world. And I think in technology, that is a major risk. There are other companies that have announced major layoffs and told their employees goodbye forever. For example, in the defense industry, that's a case where massive policy shifts created the problem rather than a new technology.
Jack Falvey, that's interesting. Roger just used a phrase, these companies saying goodbye to some of their workers, goodbye forever. Are some of these jobs going to come back in these large companies, or are they really gone forever?
The computing industry is a very unique industry, in that what has happened is that it has produced more and more technology for less and less cost, using less and less people. So those jobs are not going to come back with IBM. They have reached the high water mark for people. So they're going to have to cut back with their people, because the business dictates that they're going to have to do more and more with less and less people.
Jack, how about other large companies, though, that have been cutting back in recent months? Are those jobs gone for good?
Yes, and that's the good news, because that's what increases the productivity of our workforce. When you eliminate jobs and you get more done with less people, it's very painful, but that's what causes the productivity of the American worker to rise.
Well, that's interesting that you say it's good news to some extent. Roger, let me come back to you, because just in the New York Times this morning, I was reading a study from the AMA saying that fewer than half of the companies that are making substantial workforce reductions actually improve their operating profits. They really don't adjust to take into account the fact that they've lost workers.
Well, I think that's a little bit of a misleading comparison. The companies are under great stress. That's why they cut people. And they would have had even worse operating performance if they hadn't eliminated the people that were no longer needed to produce the goods that the customer is no longer buying. The computer industry actually is doing very well this year. Total sales are up about 30%. It's just that those are not IBM computers alone that are selling.
Do you agree with Jack, though, that to some extent this is good news in that it sort of produces a vibrance in the economy? And
well, except that in the cases we're talking about, where there's a massive shift for one company, it's terrifying to the employees. This is not a typical recession where a construction worker or an assembly line worker is told, goodbye for 3 months, we'll call you back when business improves. Your career is still fine, just to take a little leave of absence. These employees are being told, your company has missed something in the market, and we no longer need you and never will again. Now, in the case of the IBM's employees, there still is a vibrant computer industry. These people can find jobs elsewhere. They may have to move their homes and disrupt their families, but it's not quite the same problem that's facing defense industry employees who are going to have to move to an entirely different industry.
Jack, I get mixed signals in all this. I think generally it is perceived that there was some recovery in the economy in November, and I saw that 45,000 new jobs in November were produced in the private sector, and yet then IBM turns around, cuts 25,000 jobs. That takes away more than half of the month's gain. So I'm not sure exactly what this means in terms of where we're headed.
I think what this is this is a normal adjustment. The big companies have to make big layoffs. The jobs come back 1 and 2 at a time from the 15 million companies that are not in the Fortune 500. So the big news is the big layoffs. It's very, very difficult to find the jobs that come back 1 and 2 at a time in all of the small companies. So the adjustment is very healthy. It's also, once again, as Roger said, very frightening for the individuals who are involved. That doesn't lessen their trauma. But health-wise, for the economy and for these companies, this is a good thing, and it's also a very normal reaction.
All right. Jack Falvey, Roger Brenner, appreciate both of you being with us this morning.